Hi everyone, tonight we're going to talk about monopolistic competition. Keep in mind this market structure shares some characteristics with both perfect competition, which we studied quite a while ago, and monopoly. Here's a quick review of those characteristics, most of which you should remember when we were talking about the difference between monopoly and monopolistic competition. First of all, many firms exist in the market, but not as many as perfect competition. So think of it as measured in dozens of firms, while perfect competition is measured in hundreds of firms. That's just an easy way to think about it. Keep in mind as well the product is differentiated. Think of the hamburger stands we were talking about where everybody's selling a hamburger but the product is differentiated so they can exercise pricing power. Advertising also works in that effort to differentiate products. While they can have some ability to set the price of their product, they don't have an opportunity for tacit collusion. Also, there are no barriers to entry or exit, and the examples we used were restaurants and clothing stores. Let's take a look at what a monopolistic competition, monopolistic competitive industry looks like in the short run. In this case, we show a monopolistic competitor showing a profit, and that profit is because price is above average total cost. Keep in mind that because firms have differentiated products, the demand for their product is downward sloping. Remember, only in cases of perfect competition is that demand curve horizontal. The firm maximizes profit again by finding Q where MR equals MC, and the price P is found by going vertically to the demand curve and then going over and looking at P. The rectangular profit then is found by locating average total cost at the output Q. So it's this times this. And you can tell here again this firm is earning a positive profit because P is greater than average total cost. On the flip side, here's a firm that is losing money, and it's losing money because unlike the prior slide where you see P is over average total cost, here average total cost is over price. So let's think about short-run profit versus short-run loss side-by-side comparison. So in both cases produce where marginal cost equals marginal revenue, because that's a profit maximizing point. Price is determined where the straight line above Q intersects the demand curve. If price is less than average total cost, then you run a short-term loss. If price is greater than average total cost, then you run a short-run profit. And again, area of total profit or loss is determined by Q times price minus average total cost. Here you could say average total cost minus price. It'd just be, you could say price minus average total cost as well. It'd be a negative number indicating a loss. Let's talk about what happens in the long run with these two. We'll start first on where there's a profit being made. So what happens? Short-run profits attract entry into the market. Demand and marginal revenue for existing firms' products declines or shifts to the left. Remember, that's because more firms enter the market and more similar products available to the same number of consumers makes any one firm's products less competitive. What happens when demand shifts to the left? Well, weaker demand causes prices to fall. Lower prices cause economic profits to fall because the profit rectangle is getting smaller, and entry stops when normal profits are made. Okay, so moving right along, let's talk about the case of the loss. Well, short-run losses prompt exit from the market. Demand and marginal revenue for remaining firms' products rises or shifts to the right because there are fewer similar products available. A stronger demand causes price to rise. Higher prices cause economic losses to fall. And entry stops when normal profits are made. Similar to the case of profit where entry stops when you get to that point of normal profits. Let's take a look at what those movements look like. Here we have a firm making profit. As more firms enter, to chase that profit, the demand and the marginal revenue curves will shift to the left. Price will go down. On the flip side, if there are losses being made, firms will exit, which increases demand and marginal revenue, which move the demand and marginal revenue curves to the right, and price goes up. Here is the outcome, either of that leftward movement or that right movement. So left here, right here. Price equals average total cost. You can see price equals average total cost right here, and that's where marginal cost equals marginal revenue. So there's no profit or loss rectangle. The only way for price to equal average total cost is for the demand curve to touch the average total cost at the output Q. So that's an important thing to remember. We have a point of tangency between the average total cost curve and the demand curve. This happens where the downward sloping demand curve is tangent to the average total cost curve at the output Q. You can see again that point of tangency. Let's take a look at long-run equilibrium in perfect competition and long-run equilibrium in monopolistic competition. So here, long-run equilibrium in perfect competition, the long-run level of output is where price equals marginal revenue equals marginal cost equals average total cost. You can see that here. Economic profits are at 0, so our normal profit is earned, and price equals average total cost at the minimum of the average total cost curve. All stuff we're familiar with. Now let's take a look at long-run equilibrium in monopolistic competition. The long-run level of output is where price equals average total cost and greater than marginal revenue equals marginal cost. So you see here the difference. Here we have the intersection of marginal revenue, marginal cost, and average total cost. Here, marginal revenue and marginal cost coming together. But again, in the case of monopoly, you go up to the demand curve and you look for the point where you have the intersection of this vertical line and the average total cost curve, that tangent line. Economic profits are 0, so normal profit is earned. Price is greater than marginal cost. You can see here, price is greater than marginal cost. Price equals average total cost on the downward sloping range of the average total cost curve. Here you can see it again, unlike the bottom of the average total cost curve here. So those are the two side by side. It's important to understand the differences between the two as you will be asked to draw and or interpret both of those graphs. Okay, let's summarize with some key economic concepts for this module. First, firms in monopolistic competition have downward sloping demand curves because their products are differentiated, as we learned in the case, as we learned when we first talked about demand curves. This gives firms some pricing power, and firms maximize profit by selling output where marginal revenue equals marginal cost. We know that by heart. In the short run, firms can earn economic profits if price is greater than average total cost, or can incur losses if price is less than average total cost. Again, like a competitive market, in the long run, entry and exit causes firms to earn normal profits. Long-run equilibrium occurs at an output where price equals average total cost and the demand curve is tangent to the average total cost curve. This is an important one to remember because that is a distinction between long-run equilibrium in perfect competition and long-run equilibrium in monopolistic competition. Because firms don't produce a level of output where average total cost is minimized, it is said that monopolistically competitive markets have excess capacity, which they do. Ideally, we would want them to produce more, but they don't. Last, because price exceeds marginal cost, deadweight loss does exist, but this inefficiency is offset by the many diverse products from which consumers can choose, meaning consumers aren't really losing here other than prices potentially being a little bit lower, but that deadweight loss does exist because output is less than it would be in a perfectly competitive market. That's it. Have a great night, and I'll talk to you tomorrow.